Welcome, everyone. Today, my guest is Eric Lapin, president of FormFree, to talk about what's next for the company after the acquisition of AccountChek by Stewart Title. Eric, welcome to the podcast.
Thank you. Glad to be here.
Great to have you here. Now, we are speaking from the ICE Experience Conference, and you guys had a big announcement, right? You announced that Stewart has acquired AccountChek from FormFree, and you've been promoted to president of FormFree. So that's pretty exciting.
Yeah, very exciting. Yeah, thank you. It's one of those things where, one of the main reasons why I came here was just around why FormFree was started and the vision that Brent had set forth years ago, over a decade, of really putting everything in the control of the hands of the consumer. And it's one of those things that now where we are in the economic environment, as well as if we drill it down more into the mortgage side of things, there's a lot of companies, whether they're lenders or fintechs, looking to become more efficient and really figuring out who their partners are going to be as they wade through these waters.
This is a really interesting acquisition because it is coming in and carving out one of your products, right? That AccountChek, which has been, is very well known with FormFree. So tell me why this acquisition made sense to you.
Yeah, what was important with us is, AccountChek, becoming the first D1C approved for validation of income and basically off the asset of the consumer permission data. We wanted to make sure that we consummated a deal with a partner that was strategic in nature and not just a straight venture deal where it was just all about just the math and things like that. We're saying, yes, there's got to have that component to it for it to make sense for us as a business. But, who would be a good partner where AccountChek would fit into the family of companies that they already had? Is it something that can fit throughout the life cycle of the business, meaning not just origination, but can it be used in other areas as well? And does it also complement some of the other businesses that are, whether it's a technology company that sits there, is it a services provider such as, credit or flood or title, things like that, as well as the real estate side of things. So the one piece that seemed to be missing in here was the fact that everything I just mentioned, without that as the center of all of it, is the consumer. So in this deal, there was a strategic nature for Stewart, and more importantly for Informative Research, to roll it into their suite of products.
Well, Stewart has been on an M&A tear over the last year or two, so I think this is a really interesting play for them, adding it to their Informative Research part of the company that they already have.
Yeah, I don't know the exact number. I heard it on a call the other day, but I think it was 13, or it's a lot.
Maybe even more. Yeah.
That's 18 maybe. It's quite a bit, and a couple more in flight. So they just did a recent one, BCHH, which is on the title side, more on the capital market. So yeah, if you really see the plan in motion for what they were doing, the piece that was missing was AccountChek. So, from our standpoint, we're excited because it allows us to set forth and execute on the vision of having that consumer, their ability to pay, to be dynamically refreshed through a tokenization. And really, tokenization just means something representation of value. And it ties into what you're seeing set forth by FHFA and Director Sandra Thompson, and you're seeing it from the GSEs. How do we help the credit invisible? How do we help the low and no FICO? How do we work with that 45 million Americans that don't have that opportunity to get a mortgage loan, and doing it in a way that is based off of a credit profile, based off of analytics that provide insights that are around natural language processing that remove bias and really get to the point of, is this a loan that from a lender standpoint, is it a loan that is made that makes sense from a net present value? Is it also make sense for them if they're dedicated to the CRA commitment, that it helps with the community reinvestment? It helps with just consumers that may have had some things happen in the past where it affects their current credit rating. And as we all know, you have to have debt to get into more debt, and that's not for everyone. Not everyone has the ability to pay things off in a timely manner. Things happen. You have a death in the family, or death or loss of job, those kind of things. What about people that don't want to have debt to get more debt? And they say, but look at my cash flow, look at my discretionary income. I can afford this home. Why can't I have the opportunity to get this home? And we're solving for that.
So this is my next question, which is really like, what does FormFree look like without AccountChek? What is the vision, and what is it that you hope to do?
Yeah, so we're Just to be clear, we're excited about what we're doing in mortgage, but we also look at it like everything that was built here with Passport and Ricky. And for those that don't know, Ricky is Residual Income Knowledge Index. It's our proprietary analytics that sit on top of the direct source data from the consumer. And, we're looking at the fact that this is all helpful in mortgage and it helps people get mortgage loans, but what about the consumer side of it? So you have auto, you have SBA, you have merchant cash advance loans, you have digital currency types of lending where you have groups that want to utilize assets that they have with a regulated digital currency, for example, that they want to get cash from there. You have auto, you have student loans. So anywhere that there's lending extended to a consumer, the ability to pay that's dynamically refreshed based off their own permission data can be utilized with our token, which is Passport. So
let's dig into this a little bit because this is definitely a different way of doing that kind of gathering data. And the consumer is in charge of how much you gather, right? And they own their data, or they own that token so that they can then present it to different people?
That's correct. So as soon as they provide, it's real simple. It's where do you bank? And they provide that information of put in their credentials, their banking information is then harvested through an aggregation method of all of the basically open banking. It's open finance is what it's part of, meaning you have, thousands of financial institutions that that data from the consumer can be aggregated. And then that's where we put our analytics on top of it. But that information is what Passport is, and it's a token. It's the I am, is what we say. It's the I am token. It's who I am. It's my financial DNA. I'm unique. I'm not just a number. I've got some other attributes that need to be considered in this. And that's where the cash flow analysis, discretionary income on top of the income, asset, employment can be utilized as a token. And me as a consumer can share this with any lender that I want. And then when they like what they see from me from a credit profile and it fits what they want in their portfolio, then an offer is extended. And when the offer is extended and I accept it, now I send my personal identifiable information, or the PII is then sent.
So it doesn't run afoul of TRID or anything like that because, you're gathering information, but it's not for a specific property yet or anything like that.
Correct. So the way you see it a lot today, and there's a lot of time spent with pre-quals and pre-approvals and shopping for homes. Well, what about up front if you went to the top of all that? You really started with the consumer saying, here's my ability to pay. Here's my intent to do a loan. Together, I am now a qualified borrower, we call it. So instead of pre-qualified, you're qualified. Now you're underwritable for the lender to work with you. And it's just a better experience for me as a consumer. It's better for the lender because their costs are reduced. The time frame to close the deal is much less. It's something that's been needed for decades in the industry.
Absolutely. What has been the lender reaction to this?
It's been a good reaction, really positive. As with anything in business, there's some that adopt a little bit quicker and understand and ask some really thoughtful questions around it. Really haven't seen, especially where we are in the last year or so, there's been a lot more openness to like, wow, this is great. All right. So what you're telling me is I can reduce my cost to manufacture this loan, which by the way is what, $11,100. This can help with that because a lot of time and effort is reduced on the front end of it from a pre-qualification standpoint. And even after the loan closes, production of due diligence fees and other types of costs that go into it.
So I'm assuming that you have the way that you've designed the program fits in with what they're looking for, what's going to be a qualified mortgage, what a lender is already going to be doing.
Correct. They still have their own guidelines and it still has to fit the underwriting guidelines of that lender. But, if I have a Ricky on top of this and I have a Ricky score or an index that tells me what that number is, and 100 is even, a 120, 130, 140 is positive cash flow. Anything under that number is considered deficient of cash, so it'd be harder to have a qualified borrower there. All that information is shared, and with the Ricky, it allows these lenders to, if they have overlays internally, let's say they don't want to touch anything below a 660, but it's still a saleable loan, this can go in and look at the custody data of that bank, that community bank, that credit union, for example. They have a portfolio that they can lend on. What happens with all those borrowers that they have in there already, where you can have this lens, we'd like to say it's another pair of glasses that goes in and says, this borrower can afford this amount. They have the opportunity to do this. And we now see this with Ricky. Because instead of looking at history, we're now looking at where we are today with cash flow, and we're also looking at where we're going with the trend of how that cash flow and discretionary income looks.
Hi, this is Diego Sanchez, COO of HW Media, and I'm joined today by Alex Ilazai, Chief Strategy Officer at United Wholesale Mortgage. Thanks for joining us today, Alex.
Hey, Diego, thanks for having me. Good to be here.
So diving right in, we might be seeing the first glimmers of a rebound in the housing market. How is this playing out in the broker channel?
It's playing out really well, so we're excited about 2023. We see a lot of optimism in the market, just like we in 2022 and leading into Q4, and we're hitting the ground running really fast in 2023 here in Q1. We're excited about this whole year and what's upcoming. We've launched a lot of new products. We continue to see a lot of optimism in the broker channel overall. And obviously, when we're in a purchase market as we're in right now, that's where brokers really thrive in the more complex transactions with buyers and sellers and agents and a lot more going on. Just brokers are the best place for a consumer to get a loan. So we see a lot of them continue to grow and thrive.
Digging in a little more there, most forecasters are seeing rates in the 5s and the 6s for 2023 and 2024, which means we will be in a purchase market for the foreseeable future. Is this good for the broker channel?
Yeah, it's great for the broker channel. Like I just mentioned, just assume a rate's at 6%, right? We have temporary buy down products, just as an example, where you can buy down that product with the first year, you're going to pay 4%. Second year, you're going to pay 5%. Third year and beyond, you'll pay the 6%. And by that time, hopefully, we'll be in a position where we can refi that loan. So really, there's just so much opportunity. To me, the way that we think about it, Diego, is like you're dating the rate, but you're marrying the house, right? So you want to go out there. If you see the house that you like, you see the property you like, you buy it, right? And you worry about getting that lower rate maybe in a back half of the year or even next year. But again, it's just going to be a short-term thing the way that we think about it. And still, relatively speaking, we're not talking about massive interest rates, right? I mean, the days of the 2s and the 3s that we were experiencing in 2021, that was somewhat of an anomaly. So we expect them to come down a little bit, and all the forecasters and economic indicators are pointing that fashion. But right now, I think we're in a good spot, and brokers are continuing to win. And you can see it in our broker share and everything that we're doing. We're just having an outstanding start to the year.
Yeah, I mean, the broker channel's had a great couple of years of growth. Do you expect that growth to continue in 23?
Yeah, we do. I mean, as you mentioned, in the third quarter, which was the latest quarter, actually fourth quarter, is about 22.5% or so of the market is broker now, which is, I think, at the highest since 2009. So we're continuing to see great trends in the overall growth of the channel. And we expect it to be 33% by 2025-26. Like that's what we're expecting to see the numbers come in at. And a lot of that is being driven by just literally hundreds of retail loan officers that are leaving retail and joining wholesale every single month. So those numbers are continuing to do great. And we're actually seeing it as another example, Diego, at UWM here. We have about 400 to 500 loan officers that come in every single week for Success Track, which is a great opportunity for them to learn, develop, network, and help grow the overall broker channel together. So you're seeing a couple thousand people a month that are coming in, and that was happening in all of last year, right? And all the years, several years before that when we started. But if you think about like the times that we're in, right? Everybody talks about a lot of the negativity, and that's what the usual focus of. But the reality is, people are excited about it. Brokers are excited about it. The market's growing. And at UWM, obviously being 100% wholesale, no other company in the mortgage space is better positioned than we are.
I love seeing the confidence and the leaning in that's happening at UWM. Alex, thanks so much for joining us today and sharing your insights.
Great. Thank you. It's good to spend time with you.
That's interesting. So in your opinion, is that how you feel like you're getting to, maybe serve people who are underserved or have less credit or whatever? I mean, what is the mechanism there? Because if you're looking at things differently than they've looked at in the past, how does that work?
Yeah, in the mortgage business, this is definitely helping the underserved. You have the low and no FICO, which is the 45 million that we talked about earlier. We did 5 million loans last year, a little bit over 5 million loans. And speaking with some of the lenders and some of the analytics that they did on their internal lending profiles and the loans that they either retained or sold, it was very conservative to say that 1 out of every 7 or even 1 out of every 9. So we took the conservative 1 out of 9. 1/9 of 45 million is 5 million loans that have a potential to now get a home. Now, again, you still have to worry about, do they have a house in the area that they can afford there? And there's other things that come in, but that's a starting point of the opportunity or the addressable market that we're looking at of helping with that. the other thing is, you have a lot in the minority population that is just not considered on certain things because they don't have a certain score, or they don't use credit, or they pay it off, or there's just other reasons why that score isn't there. With helping that, you're just seeing a whole population of people that are now going to be considered and looking for a home. Now that's on the mortgage side. We also see it to where you have consumers that say, all right, I got my mortgage, I like this. How do I share my information? I want to go back to school. I want to get a student loan, or I want to buy this car. Those are other things to look at. Now, as we look into the future, the mobile phone is, 96% of people have some sort of a smartphone used in industrialized countries. We do a lot of work from there. We do a lot of our transacting from there, whether it's our personal goods, whether it's businesses. And you're seeing a lot of people wanting to do certain things with their data, but they don't want to go to different websites to do them and go back into another website. And then you have to download something, and then you have to scan it. We're past all that now. I mean, we're at the point now where I'm giving my information, and this is where we're seeing we go into the Web3 arena. We're going into, it's not a scary word. It's basically just saying the way that we've seen this in the past is data was being used by large corporations and other types of businesses. And I liked it in some cases where I was getting target ad because they saw what I would look for in search, and then they would market to me, which was helpful. But it's basically the version of the internet that's decentralized where, big tech is not in the forefront of something like this. They have groups that they're building, or they're doing acquisitions or M&A work to bring those companies in. This part is basically just saying, combining where we've been with social media and the use of data, but putting that back into where I, as the consumer, control my use of that data. I'm going to know where it's being sent, how it's being used. And, that's where we're seeing the Web 2 plus Web 3 come together. 2 plus 3 is 5. Now you got Web 5. That is the big thing that we're talking about. So it's really just, how do you have big tech move forward with standards that are designed to move at the speed of what the consumer wants, and how data is being harvested and analytics on top of it.
Well, and I think this is, one of the key things that we've been trying to solve in mortgage technology for a long time, because, traditionally you had, people coming in from the tech world going, we're going to innovate, we're going to do this and that, not understanding how difficult it is under the regulatory regime that we have. And I mean, not just federal, but all the state, but all the other things. It's just a lot harder than it looks. And so I think somebody who can crack that code, and people have been doing it, here and there, I think that that's really important. On the other hand, when some people hear things like Web.3 or token or decentralized, they might have some fear there. So what do you say to them?
Well, the decentralized, so you have a couple things. You do have the media that has been talking about blockchain, and I say confusing it with that it's only has to do with crypto. And the problem is, when you talk about crypto, first thing that comes to mind is Sam Bankman-Fried and FTX and the failure of Celsius and the failure of some of these other companies that were decentralized. Well, the decentralized structure is a structure that makes sense, where you have different parties that are able to share information and provide that as nodes or information that are validated by those groups that are allowed to provide that. But especially in the mortgage business, you have to have, with that technology, it definitely works and it's helpful, but you have to have what's called, instead of the DeFi, you have the CeFi approach with centralized finance on top of it. And what that means in the mortgage world and the consumer lending world is having a regulatory framework on top of that technology. So it's not like we're going to run like the Wild West, because when you leave up the Wild West, what happens? Things get crazy.
Right.
So it got crazy. These people start pulling back. Oh, I think this is all a farce. This is a scam. It's not a scam. There are a lot of groups that are doing, SEC approved and oversight from the OCC, companies like INX and Coinbase and these other groups that have to file. They get audited by the regulatory agencies that are watching it. When you start doing the true DeFi world, like you were asking earlier, that's why you get in trouble. It's just like in our industry. I think we have regulatory framework for a reason. Obviously, we needed to have it after the crash of 2008, But then again, the cost to do the loan went up 3-4x, and now we have a problem with that. So still a lot of work to do there. I don't have the solution on how to get that totally down, but I really do think that if the consumer is controlling their data and submitting that to a lender to have the underwriting done, and I'm removing bias from that, or the lender can make a decision of removing that bias. I'm submitting information that's direct from my account through the tokenization process. And tokenization, simply put, is a representation of something of value. And once that token is sent and we agree to do business, and that information comes in, and it just gives me the right to own or share something that's of value. It's precious. I'm now allowing you to have an insight into that because we want to do business together. So I've tried to simplify it, but that's really all it is. There are a lot of businesses that are doing this today, and you're really seeing it more on the consumer side. That's why we also want to go to that area. You see a lot of fintech businesses out there, and you see a lot of loans being approved very quickly. But a lot of those loans that are being approved quickly could use analytics that we provide on top of that direct source data, and then have that tokenization process included.
Interesting. I would also think that lenders would be very interested to have data now on all these people who are interested in a loan. You know a lot of things about them. They know a lot about that. They have the control of their own data. So getting to those people, super valuable.
Yeah, agree.
So FormFree, going forward, what's your passion? What excites you about this?
I'm excited about taking everything that has proven out in the mortgage business and gone through the rigor of the requirements in the audits, in the audits of getting that day 1C approval and also, approved by AIM for Freddie, and going through that process of educating and formally working with the lenders, the top lenders in the country that have accepted and adopted this and seeing success with it, taking that to the next level of the technology that's out there already being used in the healthcare area, that's already being used in the shipping arenas, that you see the shipping companies are utilizing a lot of this technology. We see it a lot in the education systems using it now as well, where that information is being tokenized and shared with around the world with all different types of certificates and degrees and things that need to be tokenized. So the information itself needs to be shared, but you don't know who it is until the contract's done. And that begs another thing. I mean, I love the fact that I've been involved in the digital currency and the use cases for distributed ledger technology and blockchain since 2013, really 2012. I think there's a space for it in many areas that it can be used. I don't think it comes in and just changes everything and fixes everything, but I think you're going to see better transparency. You see better security and chronologically stored information, that when loans want to be underwritten or assigned in a sale or some sort of pool securitization, you could do it a lot easier without having, I like this analogy. My old chief innovation officer where I used to work used to explain it like this. The mortgage business, he said, is like that little truck that's on the highway that's got the cages of chickens in the back, and it's hopping up and down with the bad axles and the old tires with no, they're all wear and tear, and it's just going up and down the street and it's bouncing, and the chicken feathers are just falling out of the side of the cages on the road. That's the mortgage business with paperwork. You don't know where everything goes.
Right.
Some stuff's over here. Oh, can you send it to me again? Oh, we can't fund your loan here at the warehouse bank because we're missing this. It's just, why are we still doing that? We're past that now. You've got a lot of smart people in this industry. They've been around. Technology's here. The data's here. The analytics are here. The brain trust of all these companies that work with one another. You see a lot of strategic partnerships that are put together. I've said this for years. I say it again. I don't think one company solves all of this. I think it's multiple companies that work together. I think it's lenders sharing their best practices with other lenders. And I think it's removing the fear of, I don't know if we can change this. You can change it. You got to remove the fear. And once you do that and you see the success, then I see movement. So that's what gets me excited about it. I think we're at a time now that there's more willingness to try something that has been proven in other industries that we haven't seen in mortgage. So it's time to do it there. And I'm also excited to work in other industries outside of mortgage that are paving the way in payments, for example. Having payment rails that can be cross-border, they're global. We're in a global economy as it is. Why not my payments? And why do I have to wait a couple days to have anything settled when it's my money going to somewhere else? They already know they want it. I'm giving them permission. It should be instant. So that technology is out there. And, if you can combine bill pay with ACH and wires and FedNow and clearinghouse, and then also have your ability to pay, all of that tokenized and sent, valuable.
And just in time for Gen Z, who is, why isn't all of this much easier, much more transparent? Why is it still this way? And also to your point, if you're looking at a lot of minority communities, they do a lot of their banking and a lot of their financial transactions, whether banking or not, on their phones. So anything that you can do to make that process better, you are already, probably upping the reach that you have.
Absolutely.
Well, Eric, thank you so much for being here. We're excited for you. We'll be looking to see how this plays out in the coming months, but it'll be interesting to see, and we'll have you back on.
Yeah, thank you very much, Sarah. Appreciate it.
Thank you.